the book that will change your financial life. 7 lessons and review of The Psychology of Money. Did you know that some of the wealthiest investors in history weren't just masters of the stock market, but used secrets buried deep within psychology and human behavior? Well, today we will be diving into the financial masterpiece that's been turning the financial world upside down. The Psychology of Money by Morgan Housel. We'll unlock the 7 game-changing lessons from this incredible book that sets to revolutionize your financial life. You will realize why some people seem to amass wealth while others struggle. It all breaks down to our emotions and mindset. Without further ado, let's get started. 1. Learning to have enough. Morgan Housel highlights that today's capitalist society excels in generating wealth and fostering envy. While many individuals are skilled at accumulating wealth, only a minority possess the expertise to retain it. The process of becoming wealthy and staying wealthy are distinct skill sets. The former demands risk-taking and optimism, while the latter requires frugality, caution, and humility. Maintaining wealth is further complicated by our societal obsession with constantly pursuing the next level of material success, fueled by the ease of comparing ourselves to others through our smartphones. Traditionally, we gauge wealth using numerical metrics like net worth, but this may not truly capture its value. Consider this scenario. An investment banker earning $500,000 annually, but splurging on a lavish house, luxury cars, and other extravagances, experiences less abundance and more financial stress than someone earning $80,000 who lives contently on an annual budget of $40,000. The reality is, building wealth is closely tied to your savings rate, outweighing the significance of your income or investment returns. Ultimately, our sense of wealth hinges mainly on our proximity to achieving a state of enough. By resisting the temptation of inflating our lifestyle as our income increases, we can witness our wealth grow while the cost of maintaining our desired quality of life remains stable. This journey leads to reaching a level of wealth where enough becomes a reality, and with it comes the promise of financial freedom. 2. Nothing is as good or as bad as it seems. Morgan Housel does an excellent job emphasizing the crucial roles of luck and risk in financial success or failure. In many ways, luck and risk are like siblings, intertwined and shaping every outcome in life beyond an individual's control. We must recognize that we're just one person in a complex world of 7 billion others, each with their own circumstances and countless variables at play. Sometimes, the unintended consequences of external events can have a more profound impact than our deliberate actions. It's a reminder that things are rarely as ideal as they may seem because of the significant role luck often plays. However, on the flip side, situations are seldom as dire as they appear due to the element of risk or bad luck involved. When we admire successful individuals, we must acknowledge the part luck likely played in their achievements. Consequently, replicating their success by merely following their footsteps might not be entirely realistic. Instead, using broader patterns and financial education principles might give a clearer picture. It's wise to shift our focus from individual stories to broader patterns to gain a deeper understanding of what leads to success. Moreover, we should exercise caution in our admiration and judgment of others. People we idolize may have had more than their fair share of good luck, and those we might look down upon could have faced particularly challenging circumstances. In times of prosperity, it's crucial to remember our vulnerability and the role of luck in our success. Where luck exists, so does the risk potential, meaning that fortunes can change at any given moment. 3. Never underestimate the power of compound interest. Morgan effectively demonstrates the concept of compound interest, shedding new light on value investing. And who knows this concept better than Warren Buffett? His wealth isn't solely attributed to being a skilled investor, but rather to his consistent investing habits from childhood. He believes in compound interest, the process through which investments generate returns that, in turn, continue to grow over time, often referred to as earning interest on interest. He owes much of his financial prowess to his early start in investing, which began at the tender age of 10. This early beginning allowed his wealth to compound over decades. While most of us can't rewind time to fund investment accounts we never had, we can undoubtedly kickstart our investment journeys today. And, well, remember, the longer your money remains in the market, the greater its growth potential. 4. Nothing's free. Every aspect of life carries a cost, yet not all of these costs are readily visible on price tags. The key to navigating the financial landscape often lies in understanding and being willing to bear these hidden costs. The challenge arises because the price of many things remains concealed until you've personally experienced it. We often hear the advice to hold stocks for the long run, and it's sound counsel. However, it's a different story when you're amidst a stock market collapse. Like many worthwhile endeavors, successful investing demands payment, but the currency is not dollars and cents. It comprises volatility, fear, doubt, uncertainty, and regret. These factors are easily underestimated until they confront you in real time. Investing is like owning a luxury car. You can choose to pay the price, embracing volatility and upheaval as part of the journey. Alternatively, you can opt for an asset with fewer uncertainties and a more modest payoff, which might resemble a safer behavioral finance approach. Lastly, some attempt a risky strategy similar to an impressive vehicle theft, seeking returns without enduring the accompanying volatility. Many investors choose this third option. They engage in frequent trading, trying to time the market by selling before a recession and buying before a boom. However, the financial gods don't favor those who seek rewards without paying the due price. Some may succeed, but most will eventually face the consequences. Like car thieves, although well-intentioned and law-abiding, who employ tricks and strategies to avoid the costs of their actions, investors who try to outsmart the market often find themselves caught and penalized. 5. Getting wealthy and staying wealthy are different things. Successful investing doesn't always revolve around making exceptional decisions. Rather, it primarily centers on consistently avoiding costly mistakes. While there are countless paths to achieve wealth, with numerous books offering guidance, the ability to sustain that wealth boils down to a specific combination of traits: frugality and a degree of caution. Morgan underscores the notion that financial success essentially revolves around the art of survival. Becoming wealthy often involves a combination of value investing, taking risks, and embracing optimism. However, maintaining wealth necessitates a contrasting skill set. It requires the opposite of risk-taking, an inclination toward caution and recognizing that what you've amassed can be just as swiftly lost. This involves a certain level of humility and a healthy dose of fear regarding potential financial setbacks. 6. Reasonability over rationality. When making money decisions, many people strive to approach them with a calculated and logical mindset. However, it's crucial to remember that we are not just numbers and spreadsheets, but complex, emotionally driven human beings. This is the core of behavioral finance, understanding the intricate mix. While the academic world may present mathematically optimal investment strategies, the real world often calls for approaches that prioritize our emotional well-being, especially our sleeping ability at night. Rational investors are known for making decisions grounded in economic facts, but in practice, reasonable investors consider a broader set of considerations, including their emotional state, their family's well-being, colleagues' opinions, and their own personal doubts. The social and emotional aspects of investing are often overlooked when viewed strictly through a financial lens. Consider a scenario where you invest in a promising company without a genuine emotional connection. Initially, when everything's going well, you might enjoy the ride. However, when the going gets tough and losses start piling up, the path of least resistance often becomes quitting on the investment. Such situations can be emotionally taxing. Now contrast that with a scenario where you deeply care about the company's mission, products, or other aspects. In this case, you are more likely to remain committed even during challenging times. This commitment may be fueled by a sense of being part of something meaningful or impactful, and it plays a crucial role in maintaining patience and perseverance. Acknowledge that not all financial decisions are driven solely by logic. They are often made to safeguard our peace of mind and emotional well-being. Our emotions profoundly influence our investments and financial choices, and recognizing this emotional component is vital for making well-rounded and sustainable financial decisions. 7. Include room for mistakes. Throughout history, we've witnessed numerous instances where promising concepts were pushed to extremes, becoming indistinguishable from poor ideas. The true wisdom in allowing room for mistakes aligns with the principles of financial independence. And well, the most effective approach to deal with mistakes is to widen the gap between your anticipated outcomes and the range of potential effects, all while ensuring that you can persevere and thrive in the face of uncertainty. Investors are normal human beings, and it's pretty common for errors to occur in their financial decisions. So it's key to incorporate a margin for error when constructing your stock portfolio. One crucial question to ask yourself is, what are the repercussions on my net worth if the value of my stock dropped by 50%? For instance, let's say an individual invests $10,000 into a stock, and it experiences a 50% decline in value shortly after the purchase. The emotional impact of this loss would likely differ significantly depending on their initial financial position. Someone with a net worth of $1 million before investing might experience less emotional distress than an individual with a smaller net worth. Recognizing and considering this emotional aspect when making investment decisions can help you build a more resilient and sustainable portfolio. As we wrap up this enlightening journey through The Psychology of Money by Morgan Housel, I want to leave you with a question that could reshape your financial future. Think about this. How might understanding the psychology behind your money decisions transform the way you invest, save, and build wealth? Are there hidden patterns in your financial behavior that, once uncovered, could lead you to financial success? Drop a comment down below, and thanks for watching.